So during that day, out of these 4 mid-cap ETFs, which one are we going to invest in? We are going to invest in number 1. So when you place a limit order for this stock, you are going to set the limit order between 2 to 5% of range, and that itself can save you 2 to 5% of money either during the buying or the selling. Hi friends. What if I ask you that there are 2 investors, investor A and investor B? Investor A is able to grow their money or their wealth by, let's say, 10% CAGR, while investor B is able to grow their wealth by, let's say, 20% CAGR. What could be the reason that investor B is able to grow their wealth by 20% while investor A is only able to grow by 10% CAGR? You may say that, Rahul, it could be that investor B takes high risk bets, right? They may be investing in, let's say, small cap stocks or SME IPOs or I don't know, mid cap stocks. They're taking high risk, while investor A might be just investing in index funds, and therefore they are not taking higher risk. Therefore, their portfolio is growing at a slower rate. That is entirely possible, and that's a very, very good answer. But what if I ask you that both investors have very similar risk profile in terms of both of them are investing in, let's say, large cap stocks? There could still be differences between these 2 investors. Investor B is able to grow their money or wealth at a 20% CAGR rate, while investor A is only able to grow at 10% CAGR. And this difference that we see in investors is what brings me to this video. Very, very important video, because in this video, I'm going to speak about 5 investing hacks, secrets, concept, ideas, practicals, whatever you want to call them, across stocks, mutual funds and ETFs that I have learned personally and that I want to share with you very, very openly and transparently using practical examples, because they will help you become a better retail investor and you are going to learn a lot. Whatever I speak on this video is not a buy or sell recommendation. It is entirely for the purposes of educating retail investors. With that, people who don't know me, my name is Rahul Jain and I'm a full-time investor and a full-time content creator. Shall we get this video started? Let's go. Let's start with the first core concept, and for this, have a look at my screen. What you see is a stock, a random stock. I'm not disclosing the name of the stock because it doesn't really matter, because what really matters is the concept here. What you will note here very quickly is that the stock has gone up and down, but if somebody invested in this stock in September 2021 at this price level here, again, I'm not showing the price level, doesn't really matter. Let's say a price level X, right? In September 2024, the stock has gone full circle and have come back to almost the similar price level, which was X, right? So in 3 years, the stock has not given any positive returns. And this is where our concept number 1 comes, which is called time correction. Many people don't understand time correction. They do understand the price correction, that in a 3 years of time period, if a stock comes from 100 rupees to 80 rupees, they know the stock is corrected by, let's say, 20% here. But when it comes to time correction, many people do not understand it and do not practically apply it. Now I'm going to show you practical example as well from my portfolio. But before I do that, understand here what has happened is that the stock has gone up, down, and this person who bought this stock in 2021 was sitting here hoping that at some point in time the stock will go up and I'll book some profits, but it never happened. In fact, as soon as they bought the stock, they would have seen 35% decline in the stock, and they did pretty good by holding on to their nerves. They held on to their nerves. They showed patience because they thought in the medium term the stock might go up. Now in such instances, although the person may not have lost money, but actually there are 2 losses that they have incurred here. Loss number 1 is the inflation, because in 3 years of time period, even if I consider 5% inflation rate, their 1 lakh rupee that they invested in 2021 has depleted by almost 15% by the end of September 2024. The second loss that this investor have incurred is that if they put this money in the FD, for example, let's say at a 7% rate, in the 3 years time, the FD would have given them 21% appreciation in the price. But here they have missed out on that 21% appreciation as well, which was very, very peaceful. It was a guaranteed assured return. Here they were sitting, losing their sleep when the stock was declining 35%. This is where I want you to understand the concept of time correction. What people don't understand is that they buy a stock, they sit on it, they watch it decline, and then they are hoping, they are praying to God, they are praying to their karmas, they are praying to their luck that at one day it will go up. The mistake here is not you bought a stock and it is declined. No, it happens with everybody. Almost in everybody's portfolio, you will find few stocks that are always in red. It's not that. But what good investors do is that they review, they rebalance their portfolio and look at their stocks that have not given good results. So right now, what you need to do is go back to your portfolio, identify those stocks that have not moved in the last few months and try to find out why the stock is not moving and what is the next trigger when the stock may move up. And if you think that there is a solid reason that the stock might go up at some point in time because you see a trigger, then absolutely fine. You continue to hold, you continue to have your conviction. But what if that you either don't understand the proper reason? Then in that case, what do? You take a financial advice from an advisor, right? Or if you think that, you know what, you can't really find out what is going to make this stock go up, in that case, it is better to think about exiting that stock. So for example, here at some point in time here, the stock gave an opportunity for this investor to come out of this stock, take the money out and put it somewhere else where there may be a better opportunity. So the rotation and churning of your portfolio is as important as you sitting on your portfolio for long to mid term. Now to many of you, this may sound a lot of gyan. Let me give you a practical example from my portfolio itself. Just few days back, have a look at my screen, you will see that this stock I invested 50,000 rupees, around 50,000 rupees back 490 days back. Okay, the stock has not moved a lot in the 490 days. I got it at 356 rupees almost, and the last trading price was at 350. And recently when I was rebalancing my portfolio, I saw this stock and I was like, no, I don't see any specific triggers that will take this stock to another level. I could be wrong, I could be right, and I took that decision there itself, came out of that stock because I know this 50,000 I can better rotate in some other opportunities. So my key takeaway from this discussion is that have a look at your portfolio regularly, every quarter at least. Find out the stocks that have not moved at all. Find out the reason. If you find a reason that they can move in the future, then that's fine. Continue to hold. But if you think that you're not clear, why would the stock move up? In that case, it is better to protect your capital and invest your money somewhere else. Before I move to the second concept, we also need to understand that growing our wealth is one thing, but protecting our future is equally important. I remember back in 2010, immediately after getting married, the first thing I did was I bought a term insurance policy because the joy of marriage comes with a sense of responsibility. And at that time, I could only afford a term insurance cover of only 25 lakh rupees. But nowadays in India, the speed at which money is losing its value, 25 lakh rupees may not be enough for many people. And in fact, nowadays for 10,000 to 12,000 rupees of premium, people are able to get a term insurance for up to 1 crore rupees. Now, whether you need 1 crore rupees or not, it really depends on your income, expense, your lifestyle, debt, and many other factors. So it's always important that you take an expert guidance. So if you still don't have a term insurance, it is high time to consider one. And if you do not know where to start from, book a 30 minutes free consultation call with Ditto Insurance. What I like about Ditto Insurance is that it is a no spam and an honest advisory that I find. The Google rating for Ditto Insurance is 4.9, which speaks about their customer service. They help in documentation as well as claim support. So go to the link in the description or in the pinned comments and book a free 30 minutes call with Ditto Insurance. Sit back and relax. Ditto's expert advisors will call you and help you choose the right term plan for you. The link is in the description and in the pinned comments. With that, let's move to investing principle number 2. The second investing concept is all about ETFs. So have a look at my screen and you will see a bunch of ETFs here. Allow me just 2 minutes and I will explain this to you in a very simple language. So let's say market is falling and you want to invest using ETFs because ETFs give you the opportunity to buy at the spot price. You don't need to wait for the index NAV price, which is calculated at the end of the day when market is falling during the day. And if you want to take advantage of that, then ETFs might be a very good way if you understand the ETF investing. Now here in this example, you will note that mid-cap ETF number 1 here fell by 9.17% during the day. I took this screenshot in a particular day when the market was falling. The second mid-cap ETF only fell by 4.82%. Again, the third mid-cap ETF you see here fallen by around 6.10%, and the last one here you see has fallen by only 2.74%. So during that day, out of these 4 mid-cap ETFs, which one are we going to invest in? We are going to invest in number 1 because it has fallen the most, 9.17%. Now, why does this happen? This happens because of the demand and supply gap for a particular ETF, right? And as long as you know top 3 ETFs in a particular space, then you can really understand during the day which ETF has fallen the most and take your investment in that particular ETF, because here clearly it has fallen by 9%, giving me the better buy on dip opportunity if I want to invest. Now most people only stick to one particular ETF. They will, for example, in the large cap space only go with Nifty Bs. No, please don't do that blindly. Just find out 3 top ETFs in a particular space, let's say large cap, mid cap or small cap or any other space that you are wanting to invest in. find out the top 3. How will you find out top 3? Look at the trading volume, look at the expense ratio, and I think these two factors are good enough to give you top 3. Higher the volume, better it is. Lower the expense ratio, better it is. Out of those 3 or 4 top ETFs during the day when the market is falling, see which one has fallen the most, and that might be a better opportunity. You may be able to save some money there if you buy the most fallen ETF. With that, let's move to number 3, and for this, have a look at my screen. What you see on my screen is a particular stock, and again, not a recommendation here, but what we are trying to do is understand the difference between market order and the limit order and understand how to apply the limit orders. Extremely practical concept that many people are not aware, because what most people will do is they will go and buy a particular stock or sell a particular stock at market order level. What is a market order level? People who don't understand, whatever is the current price of that particular stock. So for example, right now the stock price is at 832 rupees for this particular stock. They will simply go and say market order and will go and buy this stock at 832 or sell this stock at 832 level, whatever is the market price at the time of placing the order. But what you should rather try and do is put a limit order. What is limit order? In limit order, what you simply do is click here. It will show you the market value right now. But what you can do is you can say that I will only buy this particular stock if the price comes to, let's say, 825, and you are placing an order here, right? Now, how to roughly mota decide how much should be your limit order price is what I want to speak about, because if you understand this, what you can do is always prefer putting limit orders. 99% of my orders are limit orders because I know the stock moves during the day, throughout the day, and it's about capturing the stock at a price that you want to buy or sell, not what the market is telling you to do, right? And most of the times you're likely to gain some money by using this tactic. Now, how to find out the limit order pricing? For that, have a look at my screen. What you see here is a stock price chart, right? And this is what you need to open for the last 1 to 2 years. Go and have a look at the stock price chart. This is going to tell you one important thing. What do you see here is that you see very tall candles, right? Very tall candles during the day. So for example, here, if I show you the screen here, you will see that there has been a lot of occasions where the stock has gone up by here, for example, 7%. 19%, it has come down by 12%, it has again gone back to 17%, come down by 15%. So what you see here is the lot of tall candles which is showing you the daily volatility of this stock, meaning that if you want to place a limit order for this stock, you should look at 10 to 15% of price either drop from the market order or higher than the market order if you want to sell, whichever is the case, right? Because of high volatility of this stock, you can easily bargain and save around 10 to 12% depending on your luck sometimes as well. But more importantly, if you've gone through the chart and you've seen the volatility, place the limit order accordingly. Now I'll give you another example. So have a look at this stock here and look at the price chart. What do you notice here? The daily candle height is not so high, right? If I in fact try to draw some of these candles and show you a couple of examples here, 4%, 5%, 2%, 3%, 4%. So what we can conclude here is the stock's daily price movement is somewhere between 2 to 5%, not more than that, right? So when you place a limit order for this stock, you are going to set the limit order between 2 to 5% of range, and that itself can save you 2 to 5% of money either during the buying or the selling. I've used this time and time again, and believe me, 95% of my investments that I put always on limit order, not on the market order, and you are going to save good amount of money. So far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. Also, if you want to get daily insightful updates from stock market, mutual funds, ETFs, you can consider joining my YouTube member community. The feedback of this community has been excellent. Simply go to my channel and click on join button, or you will find the link in the description or in the pinned comments. Moving on to number 4, right, which is the concept of should you invest in a company that is trading at a very high PE or not? And the answer is yes and no. Actually, that is the problem with the stock market. You don't generally get a definitive answer. It really depends on a lot of things. But here, what I want to do is present to you an example and a learning about PE contraction and expansion. So have a look at my screen, and what you see is that just few days back, this particular stock was trading at around 100 PE. But within a few days, within a matter of few days, the PE of this stock has come down to almost 80, while the price has in fact gone up. Why has that happened? That the price has gone up, but the PE ratio of the stock has come down. The answer lies in the EPS, the earning per share. So for example, for this particular stock, if you look at the recent results and look at how the EPS has moved, you will very quickly note that the PE has now moved from 15.22 to 23.88 recently, because the quarterly results were announced. The PE has come down because the EPS has gone up. And this brings me to a very, very important concept, that even though a stock might be trading at a very high PE, it doesn't matter that much. What really matters is the future earning per share growth projection. So for example, if you buy a stock at 100 rupees price, and let's say the earning per share at the time of buying is only 5 rupees. So what is the PE at the time you buy it? It is 20. Now going forward, you have locked your price. The price is at 100 only. Now what happens if the earning per share from 5 rupees goes to 20? And when that happens, what is going to happen is your PE ratio is going to be only 5. For you at that time, the stock becomes much more valuable than the remaining investors in the market. So the point is very, very simple. High PE in isolation does not give you much information. What you really need to find out is the EPS growth prospect of a company, and easily you can look at what the management is projecting in terms of the profit growth rate, in terms of the top line growth rate, and can build some safety margin in terms of what they are announcing, because what they are announcing and guiding for may not be possible, may not be practical. So always build a safety margin and calculate for yourself how much of EPS growth is likely to happen in the next few quarters. And if you think that there is going to be 10, 15, 20% of EPS growth easily here, then you know what your forward PE will look like, and therefore it makes your investing decision much, much easier. And that's what typically I end up using. Number 5 is on mutual funds. Have a look at my screen and you will see that very recently I received this email from a subscriber of the channel, and what they were saying is that they do not understand the thematic mutual funds, but they invested 8 lakh rupees across these 8 categories. And when I received this email, that really hurt me. I mean, what can I say about it? I can't give them any financial advice any which ways, right? But at least I can share this example with wider audience like you, because I really do not want you to make a mistake. If you do not understand something, please do not invest, because here potentially what they were trying to do is they were trying to chase the past returns, and this is the mistake that many of us do. And to be honest, it's not our fault. Sometimes we get carried away because we see news like this, that so and so mutual fund has doubled the money in, I don't know, 9 months, 10 months or whatever, right? It is extremely hard to resist, and this is why I continue to say to my subscribers that resist the temptation of investing in something that has given massive returns in the previous time. What you really need to do is understand it, okay? Consume the data. Insight is very, very useful, but before you invest, please make sure that you understand what you are investing in and whether there is a good future growth or not in that particular mutual fund. And 2 things that I look at in mutual funds nowadays, other than many other factors like expense ratio, fund manager, etc. One of them is the investing approach of a mutual fund. Again, I have covered this in detail in one of my previous videos on the channel. Please go and watch that video. You're going to learn about how to look at the investing approach and why this is important. And second thing is the rolling returns, because that speaks about the consistency of a particular mutual fund house. For example, have a look at my screen. You will see mutual fund number 1 in the flexi cap category. Blue line is the flexi cap category return, and the yellow line is the return that this particular AMC has given. Again, I'm not disclosing the name here because name does not really matter to me. What really matters here is that how consistently they have beaten the equity category returns. That is very important. Have a look at the second one here. Here, although this mutual fund also has beaten the category returns, but you see the gap is narrower, right? And the third one, if you see here, is that this one here, there have been times where they have beaten the blue line, but there have been times where they have not been able to beat the equity returns, right? So the rolling returns tells you a lot about a mutual fund. Look at the past 3 to 5 years of rolling returns to make better decisions. Look at the investing approach of a mutual fund. Never chase the past returns. If you are not clear what you are getting into, please do not take any investment bets into it, because you are likely to lose money. There is a chance that you might lose money. And my intent and spirit has always been to try and protect your wealth, give you something that is meaningful, give you something that is data backed analysis. And if you like that, humble request is to hit the like button so that more and more people see these types of videos rather than seeing some clickbaity videos. So if you still don't have a term insurance, it is high time to consider one. And if you do not know where to start from, book a 30 minutes free consultation call with Ditto Insurance. With that, I hope you enjoyed this video. If you did, let me know in the comments. I'll see you in my next video. Until then, keep rocking.